We're getting an early estimate for Canadian GDP in November, pointing to a slight increase. And so we may, for the fourth quarter, get growth at an annualized rate of 0.5%. Nothing really to break the champagne out over. And our guest thinks we are likely to have pretty sluggish growth next year. We're joined by Charles St-Arnaud, chief economist at Alberta Central and a former economist at the Bank of Canada. Charles, thanks very much for joining us.
Good morning.
You're looking for pretty modest growth next year, maybe only 0.3% for Canada?
Yeah, well, part of it is because now we're seeing some revision to Q4, so that might push 2024 higher, but it's just the first half of the year is looking to be quite sluggish. And we can see the story going on in the data is that consumers, yes, we had a little rebound in retail sales, but continue to be affected by higher interest rates and continued impact to their purchasing power. So it'll continue to be on the back foot in terms of spending. You also see businesses not really being out there investing in their business, in their operations. So all that is kind of causing a drag on growth, especially in the first half of next year.
And you see a real risk of an actual recession in Canada?
Well, yeah, the risk is there. Like you said, yeah, growth in Q4 is expected to be sluggish at 0.5. It doesn't take much for that to be revised to a negative in the next few months. But then early next year, that's when we'll start to see the main or the most of the impact of all the increase in monetary policy or in interest rate that we've seen over the past year and a half. So that's when we should start to see kind of the weakest point in the Canadian economy.
TD is arguing that a rate hike is virtually off the table in Canada. Would you agree with that?
Well, I would agree with that. Is that it's clear that the economy is slowing in line with what the Bank of Canada was hoping to see. So to see that famous slack appearing and to reduce the inflationary pressures. But we also see inflation is coming down. It might take slightly longer than what the Bank of Canada would have liked to see, but it's going in the right direction. So increasing rate at this point is not a necessity at all.
And you are among the economists reminding us that with our population growing so rapidly, these GDP figures pointing to growth may be masking a decline in economic output per head.
Well, when we're looking, if we look, of course, considering how big the increase we've had in population over the past year and the very feeble growth, GDP per capita is still declining. And when we look at it in terms of a bit further down, like, for example, yesterday when we had the retail sales number, throughout Canada, spending per capita is going lower. So, yes, retail sales were stronger, but per person, we're actually spending less. So it looks like a recession, but because we're adding more people, it's not a recession.
Households, you think, will be a big drag? I mean, you talked about weak business investing, and that seems to have been a problem for years. But I mean, there's generous tax incentives for Canadian companies to invest. They get all kinds of handouts from the taxpayer, but they don't seem willing to follow through on that. But you do say households will be a drag here.
Well, households are probably key in terms of whether or not we'll have the soft landing where growth remains weak for a while and then we start to have a pickup, or do we get into a hard landing where you have a bit more of a deeper recession? And what I mean there is that right now we're seeing households struggling under their finances. We're seeing insolvencies in Canada rising rapidly. We're now at or slightly above the level of that we had pre-pandemic. But so far what we're seeing is that consumers are renegotiating their debt. So they're extending the maturity, they're extending to keep their payment lower to absorb the higher interest rate. But that calculation only works when you have an income. So my big concern is as the economy continues to slow, are we going to start to see a further weakening in the labor market leading to layoffs? And that's kind of where I'm a bit more concerned if we start to see that then it could unravel, because suddenly those renegotiation of debt don't happen and you have to go through bankruptcies and forced selling of your assets.
What about the labor market? For a long time, as in America, it was strong, surprisingly strong. Have we seen it weakening decisively lately, Charles?
Well, we've seen kind of an easing. We're seeing actually hiring being below population growth. So that's why we're seeing the unemployment rate gradually drifting higher, but it's still relatively strong. But when we look, job vacancies have been eroding quite rapidly in recent months. So there's a sign that businesses are no longer hiring. But as I said, the positive sign is that we are not seeing layoffs. So the question is, are we going to see a big waves of layoff as we get into next year? Or so that's the question. And I always say, and we have to be careful, is that the labor market is always at its strongest on the eve of a recession.
Oh.
So saying that the unemployment rate is low now, it's not necessarily meaning that it won't be higher later.
Sorry, what did you say? The labor market or the housing market is at
The
its
labor
strongest?
market. The labor market is always at its strongest at the eve of a recession. So I wouldn't put it that, the fact that the unemployment rate is low now, that it will prevent a recession.
Yeah, that's the classic, isn't it? The labor market is strong because the economy, employers are hiring less efficient workers, for example.
Yeah, that's what we're seeing, and that's what the whole productivity issue in Canada has been showing, is that it seems that we're hiring a lot, but they're not producing or barely producing anything, and that's lead to our decline in GDP per capita.